Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, September 17th, 2020. Felt like getting a video out. I want to convey my thoughts, a lot of moving parts to the markets, and so what we're going to do is just, this video will focus primarily on the equity markets. If I keep it short, I'll roll in a few other things I'm watching. And some related things. So what I wanted to talk about is really the QQQs. To me, again, it's all about the Nasdaq 100, all about the market-leading FANG stocks, big tech. Make no mistake about it. It's what's almost single-handedly lifted this market off the March lows, dragged the indexes higher, and so I'm watching those stocks, as I mentioned. So I want to talk on a few things. So let's start out here. With the update this morning, and I did, and when the market's moving and there's a lot going on, I'm a little more active. I'm posting in the comment section below, so let me just bring this up. Under the post this morning, QQQ, the third time's a charm, I added some comments. So yeah, I'm not going to go over that. You've already received that post if you're listening to this message or this video. So here it is. I said, keep an eye on the FANGs today, especially the big three, Apple, Amazon, and Microsoft, including that uptrend on Apple slash the recent lows I highlighted. I'm going to hit that in a second. Tesla also has a trend line off the mid-May lows that would likely usher in a big drop if when taken out with conviction. But as I like to say, support is support until unless broken. So as of now, this is simply a test of support on QQQ and Apple. So not an objective time to short. That was, I put that right after the open, or right up, yeah, around the open. Objective short entries come on rallies back up to resistance, such as we had early yesterday, which I pointed out at the time, or on solid breaks of support, ideally impulsive breakdowns. So that's takeaway number one. Hopefully, again, check the comments section. I talk about this often, that whole support is support until less broken thing. So hopefully nobody shorted around the open, because if you did, you're riding out a pretty painful counter trend bounce. So again, the notes are, those are posted in the comment section. Sometimes I get thoughts that I to follow up with the post above. And then I did this one just recently to add to my previous comments about it not being an objective time to short around the open today when the Qs were trading at support. So far we had it, when I took the screenshot, about a 1.12% bounce in the Qs, and although not at resistance, I think it provides an objective, albeit somewhat risky or aggressive short entry or add-on. And one could also scale into a QQQ short here, adding up to but not above the 275 level, as that should contain any bounce off the support levels hit earlier today. So you can see, here's the chart I posted with it. So that shows what I think is going to happen. And that's what I'll always give you, preferred scenario. What is certainly possible, and if we are going to take out those lows, which I still favor, so make no mistake about it. To me, this isn't a wishy-washy, well, the market can go up or go down. This is what I'm saying, and this is what I usually do. I'm consistent on where I think we're going. No guarantees. And again, that 275-ish level there's a big old gap there, quote unquote, should contain it. If we don't, that could still bring us only to the top of our trading range. Remember, I've been boxing in this trading range, and this is a wash, rinse, repeat scenario. So there's a lot of takeaway from these charts, posting. There's something for bulls in here, even if I don't state it, like I did state before, support is support until less broken. And I also said that if we, the potential bullish scenario, though it's not my preferred scenario, is now in play. Let me talk about that. And that was, as I said before, if we went down, undercut it, made a slightly marginal new low, it would extend the bullish divergences. And that's, again, what I showed in the update earlier this morning with the static charts. That is a new low in QQQ today and NQ. So let me say this. If you believe the market's going to new highs, you differ with where I think we're going from here at this point in time, and I may change. We go up here. I told you, I'm just going to, depending on what happens, charts are dynamic, and so is my analysis. But as of now, I'm still favoring more downside, considerable more downside too, and tradable to drop, 8, 9, 10%, maybe more. And if your mindset is we're going up, again, these are support levels that, like this one today, I'd be buying with both fists on this. This is another even bigger divergent low, and it puts into play that potential bullish scenario I laid out, that if we took out these lows with a marginal new low, those divergences would be extended, and that could be the catalyst for the next leg up. So that's that chart posted this morning. Let me get away from that one. Let me go to the updated charts here. Let's start with NQ. NQ is just a beautiful looking chart. And the way the technicals are playing out too lately. Here's that boxed area I've been highlighting for a while here. We've been trading in this range, and you've had, I mean, if you just want to keep it simple, you know, play the range. You know, go long at the bottom, cover your shorts. Go long, go up here, sell your longs, reverse, go short with stops above. And you can do that as long as the range lasts. No range lasts forever. And so the way you do it, if you, let's say you reversed, you know, sold your longs and shorted there, you have a stop on those shorts right there. Otherwise, you swing it down, you cover the shorts, or you hold out for a breakdown and again, or you go long here. So here's what we have. Let me just say, so lots of ways to trade. That's one thing I wanted to bring up. But there you have that marginal new low, extending the bullish divergences. Again, like I said here, we had it there and we got a rally. We had a divergent low there and we got a rally. And these are pretty big rallies. You know, this today was only this is over a 1% rally. So what is this from top to bottom? If you swing trade the NQs, you know every contract you have, this is a 5%, almost 6% range, about 6% from top to bottom. That's huge for a swing trader, an active trader, to catch these, even a part of it, even if you caught a fraction of those moves. That's pretty big. So this is, and like I said, and this is a trading range, and unless we break above it, it's pretty simple, but effective. That's what we're in, and I think the next break above or below will determine the next tradable trend, and I think that we go this way. So what I had said today on the follow-up is, look, we bounced about over 1%. Let me go to QQQ here and show you. You can go to 1 minute chart, and here's the bounce. So this is why you don't, if you weren't already short coming into the day, you don't short this morning at the open when we're at support. That's why you don't, because you would have, up to now, ridden out a 1.5% give back. For a swing trader, not the end of the world, but again, why risk it? Now, with that being said, because I favor the downside, and we've already had a third time's the charm, I don't think we're going to do that. So this is my, at this point, maximum bounce target. If we're heading lower up here to backfill the gap, maybe a little bit above that to run some stops, call it around 275 if you want to be safe. But I think this is what's going to happen. So as I'm doing the video, I think it's an objective time to add or scale in, like I showed you in that scenario. What does scaling in means? Means you, let's say you had 0 positions coming in today. You wanted to see how this whole thing resolved. I've been talking about bullish developments here. Been talking about bearish, or objective times to short, and all over the place. And that's because, these are the technicals. They change day to day. Bullish divergences. I would have been a fool to ignore these or not point these out or not take advantage of, the bounce. And then likewise, running up to resistance, the top of that boxed in trading range. Very simple. There's the box. All right. So where we're at now is, yeah, we can go up there. So if you were to scale in, you'd short one lot here, maybe a second lot right here with a stop above, and if we reversed, another impulsive reversal or a break of the lows, maybe that's your final position for a swing trade. I'm talking a swing trader. So 1, 2 up to that resistance level with a stop somewhat above, and then 3 take it to a full position on a break below. Now for the bulls, it's very simple. You just had the third test and successful defense of a pretty well-defined support level. Remember, QQQ hit that level here in the pre-market session this day, and it hit it again here in the regular session, and it hit it again here right before and after the open. As I showed you on NQ, that's where you can see those exact tags, almost 3 perfect tags. This one's slightly lower. Positive divergence. On the third successful defensive support, I can say this: if I thought the market was going to new highs, I would be with an aggressive long position right now, full long position with stops somewhat below. So if that's where you think the market's going, why not step in today? And we're still only about a little better than 1% above support, so it's still that objective entry. Again, maybe it happens, maybe not. And that's what stops are for. Nobody gets it right all the time. Nobody bats 1,000 in trading, not even close. And you don't need to, and especially that's the benefit of it. You don't even have to bat 500. If you're using attractive risk-reward ratios, you're only risking $1 to make $3 or more per trade. Well, you don't have to bat 500, which means 50% success ratio. You can even do under that, again, if you're just limiting your losses and compared to your gain potentials on those trades. Okay, enough on that. I'm going to kind of jump all over the place now. I'm going to show you a few things. We're going to look at the FANGs and technology I want to look at, and even talk on the bond markets real quick. All right, this is QQQ. The bigger picture is on the daily chart. We broke trendline support and then given us the first sell signal in the daily time frame for many, many months now. We broke down, we back tested it, and here we are kind of in this range. There's that same old box that I've been showing you on the 60-minute charts, and we need to break it. And you know, there's a little below it, I have a support level there. But let's look at the market leaders, because if and when they break, the market breaks. And as I pointed out lately, they've actually been a little bit weaker on the bounce. They haven't seen that vigorous buying that they've seen on the previous dips. And Apple is the king. That's the biggest company in the world. The only $2 trillion market cap company out there, and by far the largest component of the Nasdaq 100 and the S&P 500 and all that. So there's your support level right there. You can see about 109, we'll call it. And there was that flag, but I told you I'm not so keen on that flag, so I probably should have removed it. You know, we broke and back tested below. But the bottom line is support. Forget about everything. This is a trading range. It's a breakdown right here of this 60 or this not 60 minute, this uptrend line breakdown, and it's been consolidating. So as I said in yesterday's video, I believe it was, we need to take out the recent lows. And when we look at the 60-minute chart, Apple has a trend line here also off the what is that, the March 23rd reaction low and that previous reaction low. So it's just like QQQ, no surprise, being the top weighted component, it looks the same. We have basically a triple bottom here. And yeah, we're below the trend line, but only by a hair. You want to see, this is what you want to see, clear and impulsive selling. So Apple has a chance, the buyers to step in here. But so far it's showing a change of character, because in a a strong uptrend with just many more buyers on the sidelines than sellers, and you tag support, it's off to the races, next trend up. Kiss support, don't look back. Here we've come down, and so far the buyers are certainly not stepping in aggressively. Now they could, and again, then that starts to change things. But as of now, we hit it and we're already back to that support level again. So this is showing weakness. And again, we're also coming, technicals, we're forecasting the move down. There was a trend line break, et cetera, et cetera, et cetera. And then, as I said, we've, just like the NQs, we put in now, we've extended the bullish divergence. We had the bullish divergence right here. And the fact, like I said, so far that it only played out for a very muted bounce is not bullish. However, that's fine if we're going to play out and maybe put in this even larger divergent low and then start to move up higher. That would be bullish. So again, I've laid out the bullish and bearish scenarios, told you which one I think is going to happen, and I'll watch it. If and when these divergences are taken out, and if this bullish divergence fails to play out for a rally up to the new highs and beyond, very bearish in my opinion. And that's what I think is going to happen. And as I said in the post this morning, again, I know it's confusing. There's a lot of things that can happen. You can agree with my analysis or not, but the one thing I can tell you, I think that if we do take out the recent lows, we do break these support levels, and it becomes apparent, you're going to see the selling begin to accelerate. It might not be right away, or it could be. And so in other words, if you wait a day, even half a day, you may miss out on a big part of the move. So you've got to decide if that's a short trade you want to get in on. I like to kind of start building position ahead when I think it's going to happen, so I don't have to make the decision to short. If all of a sudden you get one of those waterfall sell-offs, market's down 3-4, like today, for example, we gap down big. You shorted resistance yesterday with a stop above, and so far, those positions are, where were we yesterday on QQQ? This is where we were. I said, objective short at the top of the range, and QQQ, open down today. Well, oh no, not open down. We started reversing in the afternoon. So by this morning, you're already down 4.5%. So you're profitable on that lot, especially if it's your first lot, and it gives you a little more flexibility and comfort to add, on a kickback rally like this. So that's it. I wanted to go back to the FANGs and then a few other things. Like I said, I'm kind of all over the place here. There's just some things I wanted to point out. So that's it. Just watch support. Apple's flirting with support. If Apple breaks, it is hard to see the rest of tech not breaking down. Be very, very unlikely. Microsoft starting, same things. Forget about all my other lines. I'll just try to highlight what's the most salient levels right now. There's a pretty, I think a big support level, about 201, 201.35. It was resistance, resistance. Boom, we popped it with a green candle. That's a breakout to new all-time highs. Back tested, successful. Back tested, weeks. Look at all these candles back testing. Each and every reaction further validates a trend line. That's how I use trend lines. I put a higher weighting on a trend line with numerous reactions. You've got to have close to a dozen, if not more, reactions on or very close to that trend line. And then here again, testing. And now we're right there. And that's why I think a break much below these lows, no offense to anybody here, I say this sometimes, I think a blind man would see this breakdown. You don't have to be an expert in technical analysis. That's a big level with all those reactions, all those candles there. And so I can also only deduce there are quite a few stops. If I was a Microsoft bull, I would look for support. If I bought here, well, the first level I would have been taken out, and it was a sell signal, it was a break of this trend line. There was a sell signal number 1. Now we break this, that's sell signal number 2, and I have to imagine there's stops there that the longs will stop out on, and that shorts may jump in on Microsoft. All right, so that's FANG number 2. I'm not going to go through them all, just the big 3 because they make up over a third of the Nasdaq 100. Here's Amazon. Amazon's already broken both trendline support and now this horizontal support about 30.87 or so right there, defined by all these recent reactions. And that's the other thing too. I put a higher weighting on the most recent reactions than older reactions, but there it is. So Amazon's broken down. Sure, there's a little support just below. And then bigger picture, don't forget about bigger picture stuff. Sometimes I get in a little micro world of this and 60-minute charts. It's these big divergences that have been building, and they tell me that Amazon isn't due for only a, what do we have so far, 15% drop, but a major, major trend change, and quite a bit more. And I think Amazon could come on down here at about that 2470 level. Potentially. Let's again see what happens. Support is support until it's broken. We're flirting with support. We held it today so far successfully. I said I would talk about bonds. I used to cover bonds a lot more. The bond market, it's a lot out there. It's more important than the stock market. The credit markets are crucial to the economy, to the stock market. The bond market's larger than the stock market, and a lot of pros, even if they're stock traders, they will use the bond market to glean clues, as to the health of the the stock market. They look for things like rising, treasury yields or falling treasury yields, treasury prices going up, flight to safety. Sometimes, quite often in the past, been able to identify big drops in the market that I've used to show you credit spreads increasing. That's the spreads between junk bonds and high yield or treasury bonds. When that starts to happen, that's the red flag. It shows smart money knows something's going on. Credit low-grade bonds and credit yields are going up, credit spreads, things like that. That's gone now, and this to me is one of the potential big problem for the market, something the Fed's created, because the Fed has come in and directly, with no few words, at a magnitude they've never ever done in history, come in and said they're going to backstop the credit markets. So what that's done is treasuries have gone nowhere, nor can they if the Fed's back in the market. So we can't glean any clues off here anymore. There's no natural, the whole thing of price discovery, that's the natural interaction of buyers and sellers and any security that determine what the price is, that's gone. That's gone out the window. Because if there were problems in the credit markets, we wouldn't know. How would anybody know if low-grade investment bonds credit spread should be, this is normally you'd see JNK starting to fall, saying, hey, there's problems with the low-grade bonds. We may see a lot of defaults. That could be going on right now, but we wouldn't know because, again, the Fed's going to step in, and this is what they're shoring up. Investment-grade bonds and below investment-grade bonds, particularly those have just got downgraded, like this ETF here, fallen. They've been buying this one. These fallen is bonds that were recently investment grade, that's triple B or higher rated, and they got downgraded to junk status. And again, we wouldn't know, we couldn't glean any clues here. So I just wanted to say that, and that's why I'm not covering these. And so we just have to use, the stock market right now as our guide, and not really put too much of a emphasis on what we see here. Normally in a normal market, this say, hey, everything's fine. Look, junk bonds are holding up. There's no cracks there. We had a breakdown, but it didn't go anywhere. See, the charts really aren't working. Fed's not going to let it, do this again. So then I look elsewhere. I'm looking at XLF. Actually, more particular, XLF is a financial ETF, but it's not the bank ETF. A lot of people think that. It has insurance companies and other things in there. BKX is the bank, KWB bank sector ETF. As I mentioned, it's above trend. It's pinching in this triangle with some support below. That's going to be bearish if we get that. That's going to be bullish if we get that, other than a whipsaw. But more importantly, I'm looking at the big names, the big banks. Let's see if they loaded up on my watch list. Let's try this one more time. BKX, they're supposed to load. I'm referring to watch list that's off the side. You can't see it here. It's on just off the screen capture window. All right, I can do it this way. Go to XLF and just look at these big banks here. JPM, I covered these the other day. JPM has now broken below the uptrend line right there. It's not much, but it's a breakdown. So we'll continue to monitor this. Maybe it's a whipsaw, maybe not. Let's take it on face value. For now, it's a breakdown there. And that's, I believe, the largest bank. Berkshire's an insurance company, but a big one. Not insurance company, I'm sorry, conglomerate. They hold everything. They hold a lot of insurance companies like Geico. They hold other things in there, all kinds of things. Consider it like a big mutual fund, if you will, but heavily, skewed towards financials. And look at that, look at the divergence. This is a bearish rising wedge pattern right here, and a breakdown today. I don't know, probably need to zoom in. Boom, breakdown there on Berkshire. Bank America, it's creeping below the uptrend line, but it's holding support here. I'm going to move that line just a hair lower, about $25, and you can see a lot of the market-leading, FANG stocks, that are just holding at or above price support. And so again, this all kind of plays in. We're here at support. It's, I think, a do or die time for the market, at least for the next near term. This breaks down, that's not good. Let's see, and next one up. Wells Fargo, somebody asked me yesterday because I didn't highlight it. It was actually one of the better looking banks, and I gave them this, I posted this chart. Here I pointed out it was bullish back here in May, one of the most bullish banks, and we had a big rally. I identified the divergent low. See, Wells Fargo already took its lumps. They had a lot of shenanigans they've been up to in recent years. They got called out on a lot of it. And there's another divergent low and a little wedge pattern breakout, but a breakout I said I wouldn't be chasing, just with what's going on with the banks right now. I'm not liking what I'm seeing in Bankville. TD Ameritrade, that's a big, Toronto Dominion Bank. If you have an Ameritrade account, brokerage account, that's TD. Boom, look, breakdown. Broke down yesterday, followed through today. No bueno for the banks. And then finally, Citibank, Citigroup, I highlighted the other day, is looking really bad. This is the worst looking of all the banks right now, the big U.S. banks, that is. Boom. Very, very well defined. I mean, that was resistance there, and look at all these reactions: support, 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 boom, breakdown, impulsive breakdown, big move down. And if I zoom in, it looks like a bear flag right there, or bearish pennant. So let's see what happens here. This kind of plays into the this scenario that I'm talking about, that if we take out the recent lows by a fair amount in tech and in a lot of these banks, we could get a pretty swift drop down in the market again, to the tune of another 8, 9, maybe 10% or so. And that's that for the stock market. Just kind of bigger picture stuff. Sometimes when the market's moving, I'll post a lot of analysis, but at no point in time is the stock market 100% of what I'm trading, nor do I think it should be anything. I'm a big proponent of spreading your bets, and the sectors I like, as long as this momentum keeps up. These coal stocks, I just want to keep doing updates. Another breakout today. HCC broke out of the this resistance / target zone. Pulse breakout today, up 2.74%. Arch Resources continues to run. I mean, just a nice move since the back test. You know, the gains right now we're up about 50% since the back test there, coming up on that 5063 target. So this is where, you know, the stock market, we're looking at these, you know, 5% swings back and forth in the recent range, but this to me is where, you know, the bigger gains are. You don't put as much money into these because they are, you know, higher risk. You know, they're not as diversified as trading an index, but I just want to point out, I wanted to kind of tag on into the end of the video because, again, I'm seeing more and more bullish developments. This is a breakout of the trend line in BTU. That was our first target. Here was our breakout right there. There was a recovery back above 252. That was a double buy signal, a double objective long entry, a recovery of the 252 support after the brief dip below, as well as a breakout above the downtrend line. And, you know, just from there alone, 252, it's about a 37% rally. So you can try to squeeze a few percentage points out of the stock market, which, you know, has been doable lately, or you can, you know, sit back and ride out, you know, these guys and, you know, again, do them strategically or tactically. You know, take the ones that are breaking out or pulling back to support. What other one do I want to cover today? CTR. Oh, yeah, I already covered this yesterday. It's back up to that 680 level. You can pop that. We already had a reaction. You know, there's your reaction if you're an active trader. Book profits. You know, gain back in on the pullback and then wait for the next breakout above 660. And let me look at a few more. I think this one was actually, yeah, HNRG. I pointed the breakout yesterday. Since the breakout, you know, this one's rallied about 12%. So 12% in 2 days, not bad. All right, guys, let's wrap it up here and see what the stock market does today. Like I said, there's a lot of moving parts. Tomorrow we're going to have the weekly. We'll see what happens on the weekly chart. That kind of reminds me, and we'll loop back here to that question somebody asked about, could the PPO cross today on the weekly chart? And my answer was, yeah, it's possible, but you really trading a weekly chart. The most important thing is what happens on the end of the week. So Friday's close. But yeah, at this point in time, again, it's going to take the Qs holding and rallying above these support levels. So if that bullish scenario plays out, that we just put in another divergent low, extended the existing divergences on QQQ. And so if that's it, if we just saw our lows and we're going to rally from here and go up to at least the top of the trading range and maybe back test the trend line, then guess what? These lines are likely to bounce, or they will bounce, and you won't get the bullish crossover. If we turn around and dump today or tomorrow and take out today's lows with conviction, we're going to have that bearish crossover on the weekly. And as I said, this was the last time we had it here. Pretty darn good shorting op. And you can go, I went over this recently, you can go back in time and see how you would have done shorting or getting out of your longs if you don't short on those bearish PPO crossovers. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.